If you filled up your tank or paid a utility bill recently, you've likely noticed your money doesn't stretch nearly as far as it did 2 years ago. The reality is even starker at the grocery store. Global food inflation has been running at around 9%, significantly outpacing the 2% target most central banks aim for. This animation shows the real math of this erosion. If you keep $10,000 in a standard checking account while inflation sits at 6%, you lose $600 of purchasing power a year. Earning 1% interest from your bank fails to offset that decay. You are actively losing value. Watch how this dynamic splits the economy in two. On the sinking side, we have cash-heavy savers and people holding variable-rate debt. But on the rising side, people with fixed-rate mortgages and owners of real assets, like farmland or commodities, are actually seeing their relative debt shrink and their net worth grow. Because the math impacts savers and borrowers differently, inflation moves wealth away from those holding cash and toward those holding assets. To stay ahead, you must move yourself into the protected column. The first thing that breaks during an inflation shock is the traditional 50-30-20 budget. That rule assumes your spending categories inflate evenly. But recently, housing, food, and energy have skyrocketed, while the costs of discretionary items like electronics actually fell. This chart outlines an adaptive high inflation model, a 60-15-25 split. We expand the needs slice to 60% to absorb those higher baseline costs, and aggressively trim discretionary wants down to 15%. The remaining 25% goes straight into savings and investments because your emergency reserve needs a larger buffer. Instead of holding 3 months of historical expenses, a volatile labor market requires 6 to 9 months of current real-time living costs. If you leave that larger reserve in a standard savings account, it loses value every day. You have to park that cash in vehicles that yield a return, like a high-yield savings account for immediate liquidity, or a ladder of short-term treasury bills yielding closer to 5%. And whatever you do, do not prepay that fixed-rate mortgage. Once your debt is structured properly, your investments need to outpace the inflation rate. Historically, high-growth tech stocks struggle during these periods because their value depends on profits expected years into the future, profits that will be worth much less in tomorrow's inflated dollars. Instead, you should look to real assets like energy, commodities, and tips, which adjust their value as prices climb. But optimizing your portfolio won't matter if your primary income source is eroding. If your employer gives you a standard 3% raise while inflation is at 6%, you have mathematically taken a 3% real pay cut. Reversing this requires bringing hard data to your manager. Framing requests around the Consumer Price Index shifts the conversation to market reality. You cannot save your way out of a devaluing currency. You have to lean into the advantage of your low-interest fixed loans while demanding the true market value for your labor. Relying on political leaders to perfectly manage monetary policy is a dangerous gamble. When Turkey's central bank decided to cut interest rates while inflation was already soaring, the lira lost 80% of its value against the dollar. In Argentina, where inflation has crossed 200%, citizens learned the hard way that the only method to preserve wealth is to abandon local fiat currency entirely in favor of hard assets or stable foreign reserves. Central banks in major economies will eventually tame rising prices, but often at the cost of permanent damage to your savings. Building your own independent financial shield is not optional. Here is exactly what to execute over the next 90 days. Month 1 is about assessment. Calculate your personal inflation rate based on your own receipts and consolidate or eliminate all variable rate debt. Month 2 is reallocation. Shift a portion of your portfolio into inflation-resistant assets and formally initiate that data-backed salary negotiation. By month 3, lock the system in place. Set up automated monthly purchases into Treasury inflation-protected securities or index funds to capture the benefits of dollar cost averaging. Periods of rapid inflation permanently reward the prepared and punish the passive. You now have the blueprint to protect your wealth. The next step is simply to execute it.